درود بر همراهان عزیز کانال لاین تریدرز. با توجه به انتشار ویدیوها و محتوای کانال لاین تریدرز در کانال‌های دیگر بدون ذکر منبع و بعضاً با کیفیت پایین‌تر از نسخه اصلی، به اطلاع می‌رساند جهت دسترسی به نسخه‌های با کیفیت و آخرین دوره‌ها و اخبار در کانال اصلی ما به نشانی لاین تریدرز _CC عضو شوید. با تشکر. مدیریت کانال لاین تریدرز.
Good evening, folks. Sorry I'm a little late today. I've been wrestling with what feels like it's a head cold coming on. Took my friends out to dinner the other day, and he had a head cold, and I think he gave it to me. Thanks, Sean. So take a look at this. This is our disclaimer. It's important you understand that there are risks involved. All right, so dollar index, and I promise I won't keep you too long tonight. Left-hand side chart, that is the daily chart. And we're still inside this sell-center bounce, buy-side inefficiency here. And I'm not certain yet, I'm not convinced that we're going to go higher yet. The reason why I'm concerned about it is we have this shaded pink area is the same thing over here on the right hand side. This is an hourly chart of the same instrument. So it's the dollar index, daily on the left, hourly on the right. This shaded area here on the daily is this shaded area here on the hourly chart. We have the new week opening gap, which is the abbreviation or NWOG. That's this area here from Friday's close to Sunday's opening. We always extend that range throughout the week because it will act as a magnet. It'll draw price back to it. Unless it's a runaway freight train where it just keeps on going in a trending environment, you want to be aware of where that gap is relative to last Friday's close and Sunday's opening price. Take that range, divide it in half, and you'll get the consequent encroachment, which you won't be surprised, I'm sure, to see that's where all these bodies are resting. Okay, so it's not just the ES futures tactic, it's algorithmic. So it's going to refer to these price levels, very specific, not supply and demand, not anything else. It's just simple understanding of what is coded in price delivery. It's predetermined, whether you like it or not. It is what it is. But you have to look for these signatures to repeat when you're not in a trending environment. When you're in a trending environment, maybe one time it'll touch it and then off to the races it'll go. It won't return back to it. One of the classic telltale signs that you are in a consolidation that's most likely going to continue is if we see price come back to it multiple times intra-week. We're probably not near a near-term price run of any significance yet. So you have to be very nimble, trade intraday, but there's no reason for you to be fearful or thinking that, well, I want to get a big run, and forcing a trade in that environment is problematic. So you have to be aware of where that range is, utilize it just like support and resistance. The way the books talk about support and resistance, treat that opening gap on the new week on Sunday, the highest high and the lowest low, which is going to be representative of whichever is higher, the Friday's close or Sunday's opening. The other price is going to be the opposite. So it's either Friday's close is higher than the opening price on Sunday, or Friday's close is lower than Sunday's opening price. Okay, that's the only two things that can occur. Then you divide that range of that gap in half. That's consequent encroachment. Those three levels are highly, highly sensitive. Price will absolutely gravitate right back to those very specific price levels, and you'll see it again tonight, to the tick. And I propose these things to you so that way you can wrestle with them on your own. You don't have to subscribe to the view I hold, and you'd never convince me otherwise. My fingerprints are all over it. But you don't have to subscribe to the fact that the markets are delivered by an algorithm. That if you want to subscribe to the idea that it's a free market, it's supply and demand and buying and selling pressure, by all means, run with that. As long as you're using the concepts without admitting to that view, the concepts will serve you well. Okay, it doesn't matter if you subscribe to that view or not. But looking at what we have here on the hourly chart on the right hand side, these are too clean for me. And tomorrow's trading, because we traded up into the bottom end of that fair value gap, retail sees this as a bull flag on the daily chart, and I know it's probably not zoomed in really tight, and I apologize. I was trying to get this to show up where I can do a presentation where I can show it bigger, but I'm a noob when it comes to live streaming, so it's a work in progress, so bear with me. You can get these ranges obviously by looking at the hourly chart and seeing where it's at here, and which is the encouragement I'm trying to provide for you. So don't just simply take my stuff and think, well, I've done my analysis because ICT talked about it. No, you got to go into the charts and do the work. Annotate it, that way you have the levels on your chart, and when you watch it print real time, you'll see the sensitivity of these levels or the lack thereof, and that'll give you insight as well. So what I'm looking for dollar is, do we fail to go any higher than this? Should we start to break down, what would be a valid breakdown in my opinion? Looking at the hourly chart, if we go below the lows here, if we go below these lows, there's really nothing down here that needs to be rebalanced. Everything is overlapped. Every candle, the next candle here, we trade down to that low. This candle, we trade all the way back down into this candle and run back higher. This candle, we trade back down and then overlap over into this candle's high. So everything is back and forth. It's like a well-painted wall. Okay, imagine you're a painter and you're taking the paint, applying it to the roller. Every time you roll that roller on the wall, it's distributing the paint, just like the price is being distributed to this chart here. And every time it goes up, it comes back down, making sure it leaves no gaps. So this is very efficiently delivered all the way up to here and now here. The only areas of inefficiency that exist on this chart is a very, very small little separation between this candle here, down close candle, and this candle here, that low. Very, very small one, because we have essentially repriced back down into this candle's high with this drop or this opening here. And I don't know if we're going to run higher, because all this is a wreck. Okay, I mean, this is a lot of just really difficult price action to work with. So in short, plain terms, I'm requiring the market to show me a lot more right now. Whereas I can argue that, okay, the daily chart, we've had very strong momentum on the upside. This is reasonable to expect a pause or a slowdown because of the fair value gap. But if it's really bullish, if it does rally above the fair value gap, my eye goes right to here. Okay, that buy side liquidity pool, which was an old volume imbalance, now turn potentially a buy side liquidity pool. So if we start to run higher, in other words, we get above here, what would I like to see if we rally? Not plan A, not plan B. I'm telling you what I'm looking for, because I have no hard line bias going into tomorrow. Because I can argue both sides of the equation here. I can make an argument that here's what I would look for a bullish run. This is what I'd look for a bearish run. If my analysis is ever like that, and my teachings and my students know this as a hallmark to me, I'm usually a one-way street. Okay, and this is what I'm looking for, and that's it. But the time, if you're wanting to be mentored by me, my transparency is always, when I don't know, I'm going to tell you I don't know. And there's nothing wrong with admitting when you don't know. Students generally look at me and they think that I'm always going to know everything that's going to occur next. There's sometimes I don't know. And don't try to press yourself into that expectation or hold that expectation over yourself, because it's unrealistic, it's unhealthy. You're not going to be able to sustain it. You're not going to be able to deliver on it. I can't even deliver on that. So the point is, when the market's communicating indecisiveness, I don't know what the algorithm is going to reprice to. If it's going to go higher, how would I like to see price if it's going to go higher? Let me go through that first. If we press through overnight or into tomorrow, and we get above this fair value gap, because all of this is back and forth except for this small little area here where we only had one candle come up, reprice to the low on this bearish order block. If we rally above this fair value gap and it comes down and touches this as support, preferably before taking out this high, then I would feel comfortable that it's going to probably run up into the midpoint or mean threshold of this up close candle here on the daily chart. I'll leave that homework for you to determine what that price level is. And it would have to get through that level before I would even consider here. So if it's bullish, the draw on liquidity would be mean threshold of the bullish candle on your daily chart, and then the buy side liquidity pool here. Now, this is where the argument is for me with the internal dialogue of looking for bullish or bearish, because I can frame both sides. We have left relative equal lows. What I would have rather seen today is if we would have came through these lows here and then delivered this. Then I would trust the fact that we would probably be seeing higher prices in dollar and continued weakness in foreign currencies and or stock indices. But because we have left both of them, it gives me peace of mind to rest on my hands and say, I don't need to do anything right now. That's a very important lesson for developing students, because it's always this tendency to want to do something, to want to push the button, to trade, see what happens when I push the button. I want to see what happens. Well, in this instance, if you were to do that right now, in my opinion, and my opinion is just that, it's just an opinion, you would be gambling, because there's nothing hardline in terms of high probability for it to go higher or go lower. Because we bumped up, and look at the bodies respecting the low end of that range, that's the fair value gap on the daily chart, and that's a higher time frame daily range. Also note that this right here, this low between this high and this high, that's a bearish breaker. These two down close candles together, it's all one for the hourly chart. And that's that range from this candle and this lower candle here, the two down black candles on your chart. I didn't add it here because I don't want all the business on my chart. You can do this on your own. Take a rectangle, lay it over top of these two down close candles, these black candles from my chart, extend it to the right, and you'll see we have traded up into that. So if we break lower, come back up and touch the small little fair back up in here, I would treat that would be enough for me to look for potential weakness going down into this low here. If we take out this low, then I think we're really going to run for the sell side below here. That does not mean that the dollar is going to collapse and go lower and go into 101 or something to that effect. It just means that I would look for this intraday tomorrow, which is really the climate or market profile that we're in right now, because it's indecisive. One could argue either case, and neither one of them being high probability. So you're basically gambling, and you don't have anything behind it except for you would want this to occur versus what's the market really showing you. Because if my concepts are there and it's high probability, it's going to be next to impossible to argue the other side of the equation. In other words, if I'm bearish, I see no way whatsoever for a bullish scenario. So that means I'm high probability, low resistance liquidity run going short. If I'm bullish, I see no opportunity for a shorting opportunity for me with my concepts, then I am in high probability long, and with the expectations of low resistance liquidity run. Low resistance liquidity run signatures are going to be easily identified when the market's one-sided. And don't think that it's always a trending market, Michael. That's the only one that you trade in. No. Today I did an example of it today. I tweeted out, and you'll see, I'll go over it. But it doesn't need to necessarily be in a existing trending market. It's when I'm looking for the liquidity. Once it's obvious, and I'll show those signatures tonight with an ES. Once they're there, it's next to impossible to argue the other side of it. And that's why I have strong conviction in it. It's the question I get a lot. How do I know? How do I trust? When do I know it's going to do these low resistance liquidity run signatures? When is it going to run real fast? How do you know when you're annotating the chart? When you tweet us, it's going to do this, it's going to do that. How do you know that? It's because I'm inside of a low resistance liquidity run signature within a market structure that's predisposed to go in the direction I'm trading in. Everything is heavy-handed on my favor, not against me. And there's certain things in the market and price action that will deliver that understanding to you, but you have to do this for a number of months and weeks and see it. And it'll start communicating by experience. You can't just simply listen to me talk about it. I can't give you a chart and point to this is what it is, so therefore now you understand. It needs to be experienced. It's something that you forge through experience, daily doing it and seeing it. That's the only way you're going to get that skill set, which is why the failed students in my community that either are here failing or have left and complained, they don't want to wrestle with this. They wanted it easy, 1, 2, 3, this is how you got to do, and it's easy all the time. Well, it's like that when you can identify the low resistance liquidity run signature. It is just like that. But the problem is the market doesn't always deliver those conditions, and you have to identify what that is, navigate it, or stay out of it. And I teach my students, don't try to trade in high resistance liquidity runs. You saw the way the market was holding it back the other day when we were calling it on the day the Fed chair was trying to jawbone or whatever. It was holding it down, it was consolidating, and then finally it went to where I said it was going to go, but not easily. It was met with a lot of resistance, and it keeps you feeling impatient while waiting for the trade to develop and pan out. Versus today, as we'll go over, where it's like, okay, Johnny on the spot, ICT comes in, it's going down to 41.60, and then bang, it's just a few candles, it's handed to you on a silver platter. That's what I try to teach my students to look for. Those immediate instant gratification setups where you're not wrestling around. It doesn't give you that much time to be worrying about whether you're on side or off side. It means you're either on the right side of the trade or not on the right side of the trade. If you start getting into trades and it's not moving for you within a reasonable amount of time, what's a reasonable time? I don't know. It's going to be relative to you and your personal appetite for patience or the lack thereof, because a setup is a setup, and I don't know what time frame you're going to be trading on. But if you're using a 1 minute chart, you want to be seeing some movement within 10 minutes of your entry, minimum. Okay, that you got to see something showing you. If you're in there for 10 minutes and it's not performing for you, then you're probably not on the right side, or you enter too early, or you're absolutely just completely wrong. And there's a lot of things that are beneficial to me as a teacher using these 1 minute charts, because it gives you lots of practice and it also gives you instant feedback. Whereas if I try to teach on a daily chart, it would not be as effective. But the same logic would be utilized on that daily chart. So I don't know what we're going to do with dollar. I don't know how that is going to impact the stock market, and I don't know how it's going to impact Forex. So that's what we're going through. That way you can sleep soundly tonight. I don't think it's going to be a big explosive move that I need to be worrying about because I can't see it yet. It's not there yet. Okay, the cards are still being shuffled. Okay, and obviously we'll see what happens in the morning. All right, euro dollar on the left hand side is a daily chart. As I mentioned, we went up into our city, which is fair value gap, hit that beautifully, came back down into this buy side and balance, sell side efficiency. This shaded area is this shaded area on the hourly chart on the right hand side. Now, look at what we have here. We have this drop into this fair value gap on the daily chart. So it goes down, basically down into consequent encroachment, about midpoint of it. And then we have this really nice run. Trades up to bearish order block, buy side's taken, trades up and then rejects it immediately. Comes back down into an order block. So here then we rally, and then we sloppily just increase, and then run one more time up into this, but leaves the high intact. And then we just fall off today. And now we're resting right on top of that same fair value gap that's over here on the daily chart, which is this up close candle. And I'll leave that for you. You should already have it on your chart based on the analysis and the charting I already did for you on YouTube the other day. Now, everything I mentioned for dollar, just reverse it. Okay, everything I mentioned for dollar, apply it here, but in reverse order, because everything is inversely correlated. I like the fact that there's a buy side liquidity pool here. I like the fact that we're sitting at the fair value gap again. I like the fact that we've had all of this back and forth price action in here, and we moved higher and left that there, and we dropped today. To me, it feels, and this is just me speculating right now, it's not me forecasting, I'm not co-signing, because for me to say that would be indicating that I have an opinion or bias already for dollar, and I don't. But I like that the market is sitting at this level, and we have all this rejection in here, and it just looks too obvious, in my opinion, that they left this here. So does that mean that the euro dollar is going to rally up and dollar is going to go lower? Well, if it goes here for euro, then yes, the dollar index would drop. But I don't know that yet, and there's nothing in here that would get me excited to take a trade. I wouldn't be able to do anything with it, so I'd have to wait and see what we get tomorrow. What do we see at 8:30 in New York time? What do we get at 9:30's opening? So it's a matter of wait and see, versus when there's other instances where the market is really giving me clear indications about what it's likely to do. I'll talk to you about it, and I'll say, this is what I think it's going to do, and there it is. And it'll be one-sided. There won't be the both sides of the equation, but I'm telling you the things I'm looking for. If you're watching price action and you see something that you know has been taught to you that would expect to see delivery to that level, whether it be going lower or going higher, you'll know what I'd be looking for if I was there with you at the time, saying, okay, what do you think is going to go to ICT? Well, I would think the draw would be here. So I'm giving you both sides only in those instances where I don't have a bias that's determined. So I give you both sides. That way you can study it, and you can also beat me to my analysis and or my review. So that way you can compare and contrast, what I show in the next video review versus what you already have in your annotation. So that way it's interactive. It allows you to be progressive about learning, not just simply listening to ICT and hear me talk about the things I'm talking about. It allows you to go in and let your eye and your attention go to where you like within price action, things that you want to see as a signature for your model. So it allows you to develop organically, not me try to shove you into a mold, which won't work. So we're indecisive right now for euro, just like dollar. All right, E-mini S&P. I mentioned that we had the buy side liquidity pool here a week ago or so, and we ran up into that, obviously. We have a volume imbalance here, and we have a volume imbalance in here. Ran up, failed to go above the high. Today we had a little bit of a give back. These two volume imbalances, while I don't have them noted, you want to have them both annotated on your daily chart and extend them through price action for Thursday and Friday's trading, because those levels may be impactful, and you don't want to just do a like one big bulky area. Don't use the highest high and the lowest low of the volume balances collectively. Do them individually and then label them respectively in your chart. That way when you watch price action, if it responds to those levels, and I'll explain what that means, what it would look like, they're going to behave just like the new week opening gap, which is what's being shown here on the hourly chart. So the S&P hourly chart, Friday's close, that's what this level is here. And then Sunday's opening down here. Actually, I just realized I have that on an hourly chart, don't I? Yeah, that's not accurate. Yeah, that should be on a different level. The Friday closing price and Sunday's opening price, make sure that's on your chart. Then whatever that range is, every new week, and you do the same thing every time there's a gap opening. So when we close our session at 5 p.m. each day, Monday through Friday, or not Friday, but Monday through Thursday. When we open again at 6 o'clock, when there's that 1 hour gap of no trading, you want to do the same thing I'm teaching you to do with the new week opening gap. Use the closing price and then the new opening price at 6 o'clock. And then that range, divide that in half and extend that throughout the next 12 to 16 hours. And that right there will also act much like you see with the new week opening gap. All right, so we have hourly chart here. It was kind of wild today, really. A lot of uncertainty in the beginning of the day. It was a mess. I wasn't feeling well on top of it, and I didn't like what I was seeing. And I was able to look at a couple different little small moves and such, but it wasn't until later in the day where I felt very strong conviction about what it is I was looking for. And I'll explain that now. We go into the lower time frames. On the left-hand side, there's our 15-minute time frame. Here's a homework assignment. On your 15-minute chart on ES, this high, you want to put your Fibonacci on the closing price and the high and get the 50% level. Then take your fib and place it on the 50% level down to the close. That new 50% level is 25% of this wick. That's what this level is here. Go down to your lower time frames and you'll see, much like you see over here, look how price is sensitive to that. Hits that level, trades down. Now, how's that useful? Why is it even useful? Because I'm sure some of you are thinking, well, that's cherry picked. If you think that the market is bearish, and you're going to come to these conclusions in your own analysis in your own good time. If you think the market's not likely to go through an old high that has a big long wick like that, if it's extremely challenging for it to go higher, it will not likely do what? Trade the consequent encroachment, which is the midpoint of the gap. So if it's not going to go there, where could it go? I don't do things in zones, okay? I don't just go out there and say, well, here's a big area where, if it goes there and turns around, I can come back and say, look how smart I was. Okay, I give you very specific levels because that's exactly what the algorithm is going to do. If there is no algorithm, then there would be what? Randomness. But the argument is there's all this buying and selling pressure that always completely delivers precision when you're looking for it with the lenses that I'm providing you. If you look for the algorithm with these signatures as the footprints to look for, you'll see the evidence is all over it. But if you go in with the argument that there is no algorithm, it's buying and selling pressure, it's all completely random, and retail things and organized usage of a indicator-based strategy, that's the real reason why price is going up. Then you'll see what you want to see because you're going in looking for what you want to see. But strip it away and say, okay, if there is control, if there is a management function behind price and how and when it goes where it's supposed to go, how is it possible? Because I already know there's an algorithm. You're talking to it. So if you're on the fence about it, then how does one argue how all these things with buying and selling pressure and all these theories and approaches to trading, how is it that price stops and turns on a dime and goes to the levels that I'm outlining beforehand, and their logic repeats itself over and over again, and it makes just perfect sense. It makes perfect sense when you look at it that way. I can't be convinced. No one could convince me. Like if I didn't know it for a fact, no one would be able to convince me after seeing this, like this, that there's something behind it all. There's something controlling the ebb and flow. It feels like it's organic. It feels like it's, it's a free market. Yes, the market's going to fluctuate. There's all kinds of movement around there. It's fine. But the argument you see, and this is what's proposed all the time, All you have to do is look at the depth of market, look at the DOM, look at the level 2 data. You'll see the orders. That's what's going on. Those orders are spoofed. They're not necessarily there. Just because you see them on there does not mean that that's exactly resting there. It can be there for a little while and then pulled. Don't think it can happen? Oh, there's people at Goldman Sachs that got fined for doing it. Oops. So that's a gimmick. You don't need depth of market. You don't need level 2. Everything is in the chart. It's being told to you with the open, high, low, and close. Those 4 price levels remove the idea of a free market. Because when you study price based with time, certain times of the day, the market will do certain things. But you're told over time and indoctrination that buyers are controlling the market higher and sellers are controlling the market lower. Oh, sellers are coming in, they're muscling the market. No, they're not. Buyers are coming in, they're muscling the market. No, they're not. You may be buying when price is going up, but you didn't push it there. Volume, we got a new high, but it's on low volume. That doesn't make any sense now, does it? Here we have a higher high. Look at this. Big old run up. Its candle is huge. It's really big. It goes up and takes out a previous high. But it does so in lower volume. And you're going to argue and say that it's buying pressure that took it up there. How is it arguable that buying pressure was less than the previous time it rallied up there, but yet it outperformed it in magnitude and delivery? That's make-believe. Okay? That's a fairy tale. But the big lie that's told over and over and over again eventually is accepted. And it feels uncomfortable to wake up and see things aren't really like this anymore. There's something that has transitioned. So there's something different in these markets now. And they're highly efficiently delivered. And there's nothing to be afraid of. You guys that are arguing about it all the time, you don't want to come to this team. There is no ICT team. Okay? You want to learn how to read price. That's it. That's all you want to do. And when you identify these signatures that repeat, and there's a number of them that I'm going to teach new this year, you will see there's absolutely nothing to be fearful of. They're not going to stop it. It can't be stopped. As long as there's a market, it will repeat. And that's the wonderful thing. It cannot be hidden from you. It can't be. As long as there's going to be an open and a close to a market, and the valuation that we can measure at the highest high and the lowest low, when that stops, when the ability for us to be able to see that and have that information in our hands, when that is kept from you, then and only then should you have something to worry about. Because as long as you have access to data, guess what? You have everything you need. Because everything we're reading here is how we're going to fleece the retail. We're looking at these moments where the market is likely to do damage or trick, entice, lure traders in, go up and engage a pool of liquidity for buyers. If it meets a criteria that fits a narrative, why should it go up there? Well, if there is an entity that is collectively referred to as smart money, they will use that liquidity above an old high to get short and aim for what? An old low or an inefficiency below market price. And then they will offset their short position at a discount price. While those discount prices are being viewed by retail traders as, oh, this is our stop loss because we're trying to be long, and their willingness to sell below an old low is ideal for smart money that wants to buy at a very low price. That's how they cover their short. So when you change your perspective and you have that market efficiency paradigm shift in the awareness of how price is actually being booked, listen, it's not something they want widely understood. That's why it's not taught. That's why it's not shown, and that's why you're going to see resistance to it, because there's a lot of people in this industry that don't want you to know what you're learning here. Too fucking bad, because it's happening. So back to the S&P. This quarter level of this entire wick, that right there, you want to study that, okay? And in your notes, in your journal, like something up in here, in this area here, you want to write that when there is a heavy bearish stance on price, consequent encroachment of a wick is likely not to be traded to. If you suspect that is the case, you get the very specific price level of 1/4 of the wick. Don't take my word for it. Go back through your charts and your jaw will drop. But with that said, the market trades below this short-term low here, breaks lower, and then we have the classic model 2022 that I taught last year on the YouTube channel. Market trades up into it, sells off, consolidates a little bit. We go into the New York session with relative equal highs here. That's buy side. Now, here's one of the things that you also will feel uncomfortable about. You're going to look at certain candles that I'll refer to, and you're probably looking at this and saying, well, why didn't you use this old high here? Well, look what happened. We have a SIBI here, sell side imbalance, buy side inefficiency, which is a fair value gap by classification, but specifically, it is sell side imbalance, buy side inefficiency. The market's repriced up into essentially what? That entire range here. And then we left it. So what is this becoming? A balanced price range. But we have to factor in time of day. So everything that's being shown here on the 15-minute time frame, go over here to the 5-minute chart. Suddenly things become a lot more clear because you can see now here we have 1, 2, 3 times the market has provided what? A smooth edge. In your journal, you write, smooth edges tend to be made jagged. So what happens is these smooth edges that look like resistance to a retail trader. So you're asking me, why am I not using this high here when I've already explained that? What I'm teaching you is once it's already done its work here and then it creates a lower level of smooth relative equal highs, 2 highs, now you have 3. What's the retail crowd going to think about that? Oh, that's strong resistance. So therefore they can think what? They can go short and put their stop loss, which is what kind of stop? A buy stop. So they're going to try to go short. The market provides them the reason to want to go short. What's above here? Buy stops. So the market does what? It rallies up, fails to really bump through it much here. So what does this look like? That's a quadruple top. Man, we got to write a new chapter in the books now, right? So they're thinking it's really, really strong resistance. They drop it down. They drop it one more time, take out the previous low here. Everybody's on board now. They think it's going lower. And then where does the market go? Run right back up, takes out all this buy side liquidity. I was looking for this morning, but I was fading in and out of sleep because I don't feel well. And I'm watching it and watching it. All of a sudden, I woke up from a daze and I saw the volume imbalance sitting there on the chart. And it was coming back right up into it. I was like, oh, let me please get this thing on. Because when you ever start Camtasia, it doesn't just start right away recording. It makes you wait these 3 seconds or whatever. And it's like, come on, man. Like, you got to wait for this thing to start up. And the whole business while I'm doing that, I'm trying to figure out, okay, what I got to say, what am I going to say on the chart? I was like, I'm just going to just enter it and then I'll annotate as I go. Well, because it has created this relative equal high here, and we ran up, took that, I mentioned this morning on Twitter that I said that you note 4160, which is the new week opening gap high. So that's basically it's the Friday's closing price of last week on ES. So when we're up here, I'm thinking 4160. What's the narrative that gets us there? Well, whenever you see smooth edges like this, always expect that type of scenario. And it runs up into it here. Once it does that, you're in a deep premium. The market participants are going to see that as what? That's a bullish breakout. Resistance is broken. There's buyers that have buy orders sitting there protecting a short position, but there's also traders that's thinking, okay, this is going down, maybe all the divergences that may be occurring in your indicators, which I don't need to see an indicator to know that they were diverging in here bullishly. Market rallies up and they think, all right, now I got to have confirmation. What's the confirmation? We have to see these levels here broken out. Because if it breaks out like that, then they're going to feel confident that they can go long. Wonderful. So you have buyers that want to break out and go long, and you have buyers that want to protect the short. Beautiful. That's a very, very, well, saturated area for buy-side liquidity. Who would benefit from price just going up there just a little bit? Buyers ran out of steam here. Buyers ran up here. Buying pressure took us up to here. And then all of a sudden, what? Buying pressure ran out. Why would it do that when there's a huge pool of liquidity resting right here of buy orders? Oops. Oops. Oh, we got a problem with that narrative now. Retail just failed with that logic. It doesn't make any sense. You have a huge pool of liquidity here with real buyers. Why didn't that send it higher? Because it isn't designed to do that. It's only going to go up there and trigger those buy stops. So that way, smart money, the collective entity that does what I'm teaching you to do in price action, they're going to go in and gather up all that liquidity to be counterparty to go short. They're going to sell it to those buy stops. As the market runs right up in there, when the algorithm prices it right there, that's when their orders come in. Boom, boom, boom. Where's it go? The level I told you this morning on Twitter, 41.60. I'm sorry, 41.46. So 41.46, the closing price on Friday, that was a draw on liquidity. A lot of manipulation, a lot of just back and forth, back and forth. And once it cleared these relative equal highs, then it was off to the races. Real quick, sudden decline. But now let's go into a lower time frame chart and take a closer look at it. Well, we'll still stay on the 5-minute chart here. Here's that same zoomed in area where buy side liquidity is resting here. It only bumps up to right there like that. Once it hits it, does it spend a lot of time waiting around? No. Market reaches lower, and while we're inside of this area here, we're still at a premium. So I'm going to show you how we can use the PD array matrix to map out a premium to discount market in a implied dealing range. This is the part where you take notes, folks. All right, so we're zoomed in that same area here, but now on a 1-minute chart. This is the PD array matrix, and the range I'm using here so that way you can do it on your own charts, not just simply take my chart and think you've done the work. From this high down to the 41.46 even level. Now, why am I referencing that? Because that's the target I told you price was going to go to today, this morning on Twitter. It's going to return back to what? The new week opening gap. It's going to be like a magnet, folks. It's going to want to draw back to that. Why? Because for the week, for the entire weekly candle, from between the highest high and the lowest low, if it's not a trending market, what's it going to do? It's going to treat the new week opening gap as fair value. And it's going to want to revert back to that continuously. And that allows for new sentiment to come in. Oh, it goes back to that gap. Okay, a lot of algorithms, not the algorithm that's the price engine, but the algorithms that operate on the fund level, they will likely use that opening gap to constitute their new trade idea based on a new sentiment idea because it trades back to it. Much like I'm teaching you to view it as what? Support and resistance. So if it's up here, and I'm telling you all, focus on 41.46 because it's likely to pull back to that weekly gap that opens on Sunday. What's the nearest price above the gap? It's the Friday's closing price, which is 41.46. So if that's the level we're looking for price to go to, and we're above it, and we're looking for lower prices, we create a high here. It starts to pull back and go below the high here and the relative equal highs that we've had now 4 times. Remember the slide before I went to this one? 4 times it banged into that level, and then we hit it here and then started to sell off. where are we at when price is trading right here? Are we in the red area, which would be considered premium relative to the high, to the target where we're looking to trade? We're looking for the draw on liquidity, the terminus. Where is it likely to go to? Remember, that's the thing I'm teaching all of you to focus on. The part of this puzzle is not knowing where it's going to next. And you're focusing on all the order blocks and what fair value gaps and when they're staying open. You're missing the whole entire plot. You have to be trained this year. Use this time with me to understand why I'm teaching you how I'm teaching you. Where is it likely to go to next? Because all that question of what you're looking for and why it does this and shouldn't do that, that becomes much easier to figure out when you know what the market's likely to do. And also, if I don't know what I'm doing, I won't be right, will I? It means there's no algorithm. That means there's no way that there's an algorithm. If I'm calling specific price levels as the next draw on liquidity and they don't continuously, consistently deliver, guess what that tells you? There is no algorithm. And every friggin' day, I'm telling you. I'm only tweeting the wins. I'm not deleting anything. So come on, join the party here. Okay, this is the real shit. Okay, I'm just gonna tell you like that. This is the way it is. This is it. This is the thing you're looking for. But you cannot learn this with one video or video series. You have to be walking it with me. And you see it, and you understand it, and you'll understand what each candle means each time it creates a new one. It falls into place into a storyline. The storyline is they ran the buy stops above those highs. Ran it right up in there. Broke lower. You already knew 41.46 was where we were looking for the draw on liquidity. I guarantee you, when you were seeing this rally up here, you're like, oh, ICT got it wrong. I'm not gloating. I'm just telling you, I see this happening. It's like I'm reading all of your minds with these candlesticks. When this thing starts to break down and we have a target, 41.46, you need to take your high, if you're short or if you're looking to be short, the high that it forms that you think is a suspect high. A suspect high is a high that's been blown out, and you want to see if it maintains the rejection. So we don't know if this high is going to be, well, taken out, if you will, until we trade from premium to discount. We have that right here. Then the market does what? Returns back up into a premium. I'm scrambling to get Camtasia open right here. Finally it gets open. I get my chart open, and then right here. What's occurring? Look closely. I've already shared it with the Twitter community and actually showed an execution. So I traded this, not just simply me talking about in hindsight. So you can look at the video on YouTube. I'll take the annotations off in a second, but look what we have here. We have the high to 41.46 even, which is the Friday closing price, which is the high end, the top of the new week opening gap. With that price level as a magnet, if price is up here relative to that target and the high is here, if we go short in here, we're shorting what? At equilibrium or premium. Either one is okay. But you can't go in and start pyramiding once we get down into here. Because once we start crossing into the halfway point of the discount level, you're too much in a discount to add more to it, which is the reason why you see me do one and done, and there it is. I got in. There was no opportunity for me to pyramid. It was just a straight shot. 41.46. Thank you very much. Wham bam. Thank you, ma'am. But let me take the annotations off, and you can see. Pay no attention to the fact that the standard deviation 1 takes us down to that really nice low. But that's just extra, no charge. So here's the level. That's equilibrium. Do you see the volume imbalance right here? I've been teaching it. That volume imbalance is at equilibrium and then a very small premium. My entry was short, instantly delivered. This type of movement right here, that is exactly what a low resistance liquidity run signature performs like. Now, do you want to be in a move like that? Or do you want to be in a move like this? Buying down here, hoping it gets to this level up here. Buying here, riding it, rolls all the way down this deep against you, rallies up. Okay, it's going to give it to me. It's going to give it to you. Nope, it rolls back against you. If you put your stop here, you're taken out. Then it rallies up here, but you've been taken out. But it went to your target. That still happens to me if I trade in high resistance liquidity run signatures. I can trade in them, but it doesn't give me peace of mind. I don't want to be in a trade that has this roller coaster back and forth and still gets to where I think it's going to go. There's other days to trade where I won't have that, which is how I teach my students to trade. When we get in, we're looking for very quick responsiveness in price. We want to see instant feedback. We want to see how price goes right to what we're looking for. We don't want to be messing around. We don't want to be sitting around worrying about twiddling our thumbs, hyperventilating, huffing and puffing, cussing, cursing the market. I've been there, folks. I put my fist through several monitors over my career. I've done it. I don't do that anymore. It's boring to me. If I got it wrong, I got it wrong. I'm not going to lose my mind over it. I know what I'm looking for. In the future, it will repeat. It just means I've done something incorrect. And I assume that responsibility as a trader. But you won't hear that in books. You're going to hear people say, push your edge. Don't worry about the drawdown. Trade your way out of it. Everything that's wrong. That's what's promoted. And there is a logic to look for opportunities that deliver instantaneously, powerfully, energetically. And it repeats over and over and over again. Look closely. The volume imbalance here. Why am I even looking at that? Because of everything I just outlined, how fast we move from this high. It's not likely to do what? Come back up to any of this imbalance. It's showing us what? Volume imbalance here, a fair value gap, another fair value gap, another volume imbalance that did what? We traded up into it here with that little bit of a wick, and we went down into discount. Halfway between the high here and the target of 41.46. So I know some of you are thinking, okay, this is really complicated, ICT. It's not. It's only because you're seeing it explained to you for the first time. It gets easier as you see it with me. You start walking through it and you'll see this is exactly what I'm utilizing. I'm not creating new things each time to keep you from ever learning it. My whole time with you this year is for you to learn this, not hold my hand, ICT. I don't want to hold anybody's hand. I got a wife and that's the only hand I'm trying to hold. This return back into that volume imbalance right there. That's it. That's the last bus stop. And then we're out of here. Elvis left the building. And here we have it, delivering right where I said it was going to go. When nobody else up here was expecting that price there. So the narrative was run the buy stops, accumulate that as a short position for smart money. So the composite man sells short to the buy stops and buys the sell side liquidity to cover the short. And the market rallies up to some random level between this candle's low and this candle's high, which is consequent encroachment. That's exactly what you're seeing right here. And the market trades lower. So the market trades down to midpoint, rally, midpoint, sloppy, 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 sloppy. And then between 1050 and 1110, there's going to be a macro. I already know some of you are thinking, okay, but you said at 1050 to 1110, and then there's 11, there's two of them, okay? What did I teach you with Forex? What happens between 10 a.m. in New York local time to noon New York local time? What time of day is that? That's London close. That order flow that comes in at that time, you're going to have a macro that occurs at the 10 o'clock hour and the 11 o'clock hour. Then at noon, between 1 and noon, New York local time, there's an algorithm that runs there too, which returns us back to what? The morning stops. There is a teaching coming I want to make sure I have it in video format because I know some of you guys are writing books to try to put it in print to beat my books out there, but you're not going to be able to efficiently talk about it. You'll talk about something I've already done in a video. And in my my books will refer to videos that I've already put out in public. So that way everything's time and date stamped and everybody knows where it came from. I'm sorry I have to do it like that, but these goobers out here, they're trying to make a name for themselves. It's just ridiculous. So between the 10:50 and 11:10 hour, there's a macro that will form that makes a run on liquidity that has not been taken yet. What does that look like? We have the market rally up and then breaks a short-term low here, relative equal lows, trades down, and then creates this fair value gap. It's a gap, yes, but what kind of gap is it? SIBI, S-I-B-I, sell side imbalance, buy side inefficiency. So what is it lacking? Delivery on the upside. So it overshoots it here. That's fine, no problem. Small little gap here. If there's a gap like that, your stop has to refer to that as well. Remember, if there's two fair value gaps, your stop has to at least respect that higher level fair value gap. Well, it means it's a larger stop. That means you're using less leverage. Okay, stop trying to be at the highest form of leverage. Just because your funded account says you can trade 15 contracts doesn't mean go in trading 15 contracts. Believe me, they want you to fail. They make money doing that. Okay, and again, that's the reason why I'm not going to have a relationship with any of them. They can beg me to sign up with them all they want. I'm not going to do it. 2, you have to do this responsibly. And there's a right way of doing it. And that means managing risk, not managing the potential to make the most and use the most leverage. That's what you're trained to do. Every influencer out there is telling you to do that. Push it, stack your funded accounts, get 20 accounts. Yeah, get 20 of them. Because when you blow all 20 of them, that means you're going to have to do what? 20 re-ups. They want that. They absolutely want it because they know greed is going to tap you on the shoulder. You may conquer fear for a little while, but greed's going to be like, hey man, listen, it's real easy to restart these things. So just risk it. You want the biscuit? You got to risk it. And then you shit the bed. Well, they got 20 new restarts, bang, just like that. Because they know you're not going to stop. You're going to do it. So when you have two fair value gaps, your stop loss has to respect that. And that means you have to do what? Use less leverage. It's about making money. It's not about showing on social media, I'm trading with 15 contracts because that's the $150,000 account limitation I can trade with. I'm doing full leverage. My lot sizes. We're talking about male genitalia measuring up again. That's not what this is. It's not about that. It's about consistently managing risk impeccably, being precise about what you're doing, when you're doing it, why you're doing it, taking partials along the way because you don't know if your targets are going to get hit. I can hold for full terminus. I can do that. But if I demonstrate that all the time, you're going to be wondering, well, I can't do that. And you're going to fail more times trying to do that versus learning to take partials, giving yourself that green belt, that blue belt, that red belt, brown belt before you get to your black belt, which is holding trades to terminus. I can do that. I can do 100 handles up and down. You've seen it. But I teach gradually. Take small bites of that elephant and you'll devour it. But it takes time and it takes discipline to do these things over and over again. Being content with enough. You've done enough to learn this much this week, this much that month. Over the last 3 months, where have you gone? What's your progress like? So back to the macro. Remember, this was supposed to be a real short video. It never ends up like that. Just like a Twitter space. You always get more than you paid for. So in this imbalance here, it rallies up into this small little fair value gap here. And then we have the move lower. We trade down to the low here, rally back to the midpoint, break lower once more, sell side. So every instance of London close between the 10 o'clock hour and 11 o'clock hour and noon, there's several things that occur that are algorithmic. I'm going to give you specific details about what you're looking for, when it should form, what times and what days is it not likely to form, and disregard it. They're usually trending days. Trending days, you're not going to see a macro. It's just going to be like, boom, goodbye, off to the races, and it's not going to be anywhere seen. But how many times do you see that in trading? It's not a lot. So most of the time, you're going to see certain little quirky things that repeat, and you can trade with them. You're going to find that they themselves can be your entire trading model. So what does that mean? You can schedule your business down to a 20-minute window. What? Yes. Yes, Dorothy, we are no longer in Kansas. Okay, we're in the wonderful land of Oz. So anyway, the market comes back up, fails to come back up, and falls short of the closing price on Friday. And then big surge lower, trading down into the low, that Fibonacci from the high down to 41.46, pretty much nailed that. And then we traded into some sloppy conditions going into the afternoon session. Now, before I go on to the next slide and close this discussion, if we know that the market has traded from the high here, lower, what is the lunch hour going to do? It's going to run on what? Buy stops. So buy stops during the morning session, where would they most likely be? Well, you have this here, but we haven't. We don't have a whole lot of interest in something so shallow like that. Also, what did I tell you to look for throughout the entirety of the week? If there's an opening gap on Sunday, you extend that through the entire week. So, are we interested in just running these here? No. What high is between the gap that's formed on Friday's close and Sunday's opening? This high here. So 41.46. That's the morning high. Why? Why am I going to pick that? Because it has to do with that weekly gap opening. The market's going to want to do what? It's going to want to draw back into that. So, who's making money right now at this time of looking at the chart right here? Who's making money? Shorts. So where's their stop? Yes, they're right here, but more specifically, they're right there. Because this high is forming when? At noon. You're already in the lunch hour. You're already in the lunch hour. That's not a high that runs the AM session high. I'm not saying the highest high. I'm saying the most recent high. Because why? Think, folks, think. As the market's dropping, if they're short, what are they trying to do with their stop loss? Jam it down to the next relative high. Because they don't want to see that high taken, so their stop loss is going to be put just above it. So that's why you're going to focus right here. You understand that? I know you can't answer me, but think about it. When you're looking at price, you have to think about who's in that trade. How are they managing that trade? What is the worst case scenario for them on a nightmare level, that if they think it's going to keep going lower, say in their mind they think it's going to go to 4,000 even. I'm not saying that, but I'm saying that there's traders that think that kind of stuff all the time. They don't want to see their high taken out. Even though they have their stop loss there, they don't think that's going to happen. Well, ring in the lunch hour. Here's the noon hour beginning. That's that short-term high. I said we're not interested in that. We're looking at that high here. So this high has AM session buy stops. So between noon and 1 o'clock in the afternoon, all this movement here, this is a high resistance liquidity run too. It's a lot of roller coaster ups and downs, ups and downs. And where does it go? Ultimately, right where I mentioned that we'd see logically the AM session most recent high that would be considered a high for trailed stop losses while the market dropped in the morning session. Real important, folks. If you don't have that recorded, if you didn't hear it properly, listen to it several times in the video, because it's very plain language. It's plain language. It's plain English. It's very simplistic. But if you're new to trading, if you're new to speculation, and or even using a stop loss, because there's a lot of people out there that just don't even use a stop, those that use a stop think like that, because that's what retail books and logic teaches them to do. I'm telling you how to be a carnivore. I'm teaching you how to be a predator, to go after these retail-minded theories, because they're flawed. They're designed to fail. They're absolutely leading you into the slaughterhouse. You're following all this Judas theory. You don't identify it because you think it's just, well, it's randomness that got me stopped out and I'll just hopefully win the next one. No, you're losing because you are trained to lose. You're taught well. Lots of books and lots of authors out there keep promoting that garbage. It's not real information. It's misinformation. So the buy stops that are resting above this high here, we run through that. Where? Post lunch on the other side at 1:30. 1:30's here. We're missing it by a minute or two. One more time it runs it. But look at this high here. Go back and look at your charts. Your jaw will drop. Go over to this volume imbalance right there. This candle's opening price, which is the low of the volume imbalance, that tick is the very tick high of that candle right there. So how far can it go above this high to run the stops? Well, look to the left up. What do you see? You see this wick. Consequent encroachment is just above that. That's not reasonable. If it's going to run there, it's going to run a little bit higher. So that means it's going to go above this. So what's above that? Volume imbalance. Bam, hits it. Failure. You're thinking bull flag. You're thinking it's going to continue higher. It's not. Only thing it's done is reverted back to that weekly opening gap. And it's broken above it here to do two things. Take out the stops here that were trailed for shorts. And induce new buyers that think of that opening gap as a breakout. So now we've done what? We went below it. So now if we can get back above that opening gap for the week, large funds will come in and they'll buy that. So they're doing what? Buying on a stop. They're buying with the expectation it's going to continue higher. All the way down into here, cleaning up all this inefficiency. We have sell side below here, 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 and stacked heavily at the AM session low. Small little fair value gap in here. Mean between the high and the low. So the middle part of that is a consequent encroachment level. Trades right up into it here. Beautiful delivery. Fair value gap. High to low. We're in a premium. Think about that dividing of the range. From this high to that low as it's retracing, we're in a deep retracement. I don't need an indicator to tell me that's overbought. Do you? Do you need to plot a Fibonacci on this high to that low to see that we're not already in a premium? Your eyes have been trained to it by now. So the only thing you're using Fibonacci's for is to find out the exact price for the mean threshold of an order block or consequent encroachment of an imbalance or project targets. That's the only reason why I touch a Fibonacci. That's the only reason why. This is optimal trade industry. This is OTE. That's the flagship pattern of my channel until I guess the 2022 model was given to you last year. The market breaks down below 41.40 and a quarter, comes back up, hits it, fills in a fair value gap there, breaks lower, small little imbalance here. Incidentally, this is your homework also. This wick right here, and we're looking at a 1 minute chart. So this wick right here between 4:15 and 4:30, that wick, find out what that consequent encroachment level is on that, the midpoint of that wick. Extend it through this fair value gap and you'll get the very tick high of this candle right before it drops down. Yep, that's one of my favorite pet entries. I love that one. I love it. And it'll serve you well when you know what you're looking for. Don't take my word for it. Go in and look at your chart and you'll see it. It's perfect. It's a perfect to the tick delivery on that candle, and then suddenly it delivers. Goes lower, trades back up into old order flow here. One more time. What do you see here? 1, 2, 3. Breaks lower. What's below these relative equal lows? Sell side. So the market went up here for buy stops, then ran down below these lows that was engineered. Starts rallying. Someone's going to buy that. They see this is a bull flag. It rallies up. Oh, it's going to break out. It's going to trade up to here. Even if they don't think it's going to break out, retail logic thinks, okay, this is resistance, so hold it until it gets to that level because that's our target. They're not thinking trade up and through it. They're thinking it's going to go back up here. It's got room to still rally. No, it doesn't. We're stalling here, turning, then attacking the sell side that was engineered with these runs higher. Buyers are going to have their sell stop below that, which is convenient for the smart money that's selling to the old buy stops here. They have a net short position. Smart money's net short here. They add here. They take some off here. Rallies back up, fills in an inefficiency. This high here falls just one tick short of consequent encroachment here. Don't take my word for it. Go into your charts and you'll see it. Trades below these relative equal lows. What's below that? Sell stops. Why? Because the market rallied up. Somebody's going to chase it. They'll chase it and buy it up here and put their stop loss down here. You don't think they can do that or think they won't do that? Look at social media. They're doing it all the time. The market drops, attacks the sell side here. That's a partial, and then bang, right below the morning session low. Smart money sells short, adds the shorts, takes partials, adds the shorts, covers at terminus below the morning session low. And then, and only then, the market goes back into sloppy choppiness, getting ready for another day of the slaughterhouse on Thursday. So, this year I've talked about a number of things repetitively, and I've said certain things about the opening gap, and I said to extend that through the entirety of the week. As long as we keep coming back to it, and we're not moving decisively away, we're not in a trending model. We have to trade short-term price fluctuations and look at buy-side liquidity, sell-side liquidity, inefficiencies, and be nimble. Take our setups, get them and get out. Don't fall in love. Don't marry the vein. Don't go in thinking, oh, this is a short-term trade intraday, but now it looks like it's really going to go higher. Let me hold on to it, because you will see it reverse on you. How do I know that? How do I know that you have to trade that guy? Because we keep coming back to that weekly gap opening. Think about it, folks. If this market was going to tear off, it would have done so, right? And would it be coming back to this opening gap on Sunday? No way. Absolutely not. So, use this insight going forward. Yeah, I promise you, it isn't me just using it when it works, because I've already taught this and my students use it. It's something you trade with in perpetuity. You use it in the future all the time because it's going to repeat. It's absolutely going to repeat. Look at the logic that I've already outlined before tonight. It's in this chart right here. It's doing exactly what I codified, exactly what I trained you to look for. This is exactly how it's coded. And it repeats every week, every day, and it won't stop. So if you found this one insightful, and I don't know if I'll live stream tomorrow or Friday, but I will let you know by way of Twitter tomorrow how I feel. If I feel like I'm going to have the energy to do it, then I'll do it. If not, we'll do it on Friday. Okay, but I will certainly do it by Friday, if not tomorrow. And the only way you know is on Twitter. Until next time, be safe.